Hi Jay, good morning.
Hi, Ramya. Good morning.
So Jay, since this is a big week for a few of the Mag 7 earnings, I wanted to have a quick chat with you on some of the stocks that I hold and what I can do to hedge in case the results are not so good or something like that. So I happen to have 100 stocks of Google. Um, and the earnings is tomorrow after the bell. So since 100 stocks enables me to do some option contract, what do you suggest my options are for hedging it? I don't want to sell it yet, but I feel the stock has gone up quite a bit. So the earnings could go either way.
That's a great question, Ramya. First thing, I think Google, which trades under the ticker symbol of alphabet, has run up quite a bit. And yeah, it can go either ways. It can further go up or take a nosedive. And options are a very good way to hedge what you have and also make your stocks uh, work as an income generator as well. So, and another thing is around earnings is the best time to get into options. Both the put side and the call side typically are loaded with very high premiums just before earnings, and after earnings, it kind of crushes down, so you can actually capitalize on the premium, especially around earnings. Having said that, let us possibly get into the Fidelity Active Pro and look at the options chain to see if there are any good strike prices which we can take uh, for entering into a covered call. Covered call is a good way to hedge your stocks. You're capping the gains, but at the same time, you're also providing some downside protection. So
So
having
covered call is like a sell call, right, Jay?
covered call is a sell call. Spot on, Ramya.
And
So,
so I acquired my average price of Google stocks is around 220.
mm-hmm.
Um,
Okay.
so
So when we choose the strike price, and you can possibly typically when you write a covered call, there are two ways to do. One is you choose an expiry which is less than 60 days from today, which in which case if I remove the weekly options, and what I did here was to if you have this W on, you will see all the weekly options as well. Around if you remove and include only the monthly options, typically the volumes are high and you get good bid ask spread and all that. So if I
okay,
take December 19, which happens to be um, less than 60 days, and you said 220, right?
yes.
So, okay. If you actually see, if you choose 300 as the strike price, it's maximum open interest and very good volume. And this is coming at a delta of 25, which means that there is 25% chance that it will hit 300.
Mhm.
And you are gaining a premium of anywhere between 560 to 570. It's a quite tight bid ask as well. So are you okay to first of all give up Google stocks at 300 is something, it's not just 300 plus the premium receipt. So there
Right.
is uh, quite
Yeah, I
a
think
possibility you can get at this
yeah,
strike
I
price.
think 300 sounds good for such a short term from my returns perspective.
Sure.
I would be okay to um, give it up or sell it at 300.
Sure. Then let us try and see if we can simulate this using Active Pro. You said, first of all, you own 100 stocks, so I will put that, and I can even put the cost basis here.
Okay.
because this is simulator, right? So
Right.
I'm saying we have got it at 220. So I'm adding this 100 stocks. So this is your 100 stocks.
Okay.
Currently, it is sitting at around $4,798 gains.
Right.
And if I need to add a covered call, we will just say sell to open one, and we chose December, and then we chose 300 here, and here you have to choose call. So this will give you a credit. When you do this, when you actually add this covered call, you will actually receive $560.
Okay.
So by December, if Google hits 300, I mean the break even is showing as 305.60. Reason being, you are receiving this premium also.
Right.
So if someone exercises this contract, you will lose your 100 stocks. But
Right.
you will lose your 100 stocks at this price, meaning that your maximum gain from this stocks plus the covered call is $8,560. So
Okay.
the reason why we can enter such a covered call is, forget about the stock now. Now just look at the covered call alone. Let's say that after earnings, Google drops to 240 or 230.
Right. Right.
All you need to do is just close this covered call, or probably roll it to a further date for same 300 or whatever it is, and book this profit. As you can see from this graph here, if it falls down to 250, this covered call would have gained $331. Meaning that, I mean, you have
Right.
upfront received 560, so you will end up returning only 560 minus 331 back to your platform owner.
Okay.
So this is a nice way of protecting your 100 stocks from the big swings that could happen possibly around earnings.
Right.
If you're okay, and see, let's say if Google goes up to 290, and then this will lose value, meaning that you will end up having a loss. You will have to give back this 560 over and above this particular loss. But if you're okay for giving up your stocks, you can just stay put, or just take this and roll it as well. There are multiple options, and we can see that after earnings as well, how whether it went up or went down. So this is a nice way of hedging your 100 Google stocks.
Okay. And then now what if I don't want to sell it in December for 300, because I just recently acquired Google stocks? What if I want to hold it at least for a year so that, I can do long-term gains instead of short-term gains on the stock?
That's a great point. For example, this one, if it's called away, very good point, Ramya. The reason is, if this gets called away, let's say that if we just stay put and then this gets called away, and you book $8,560 profit, meaning that that's the maximum, and Google went up to 310 or 320, so you're booking this profit, you'll end up paying the short-term gains on the stocks as well, because that has got called away and you made profit out of the stocks. So in order to avoid that, there is another possibility where, again, we can go into the options chain and type in Google, and I'm taking all strikes and I'm removing the weekly options. Then you go far out, maybe a year from now, or December 2026 will be more than a year. So
Right.
so I'm looking at December 2026, and since you are kind of going far out in date, you can go to a much higher strike as well. You don't have to limit yourself to 300, because that's a very high chance of Google moving to 300 by
By
this
December.
So, and what is the price that you are comfortable selling your Google shares at? Does 360 or 380 the farthest that is available in the options chain? Does
Right.
360 or 380 sound okay to you?
Yeah. I think that would be good.
You would pick, can we do 360?
Yeah, because that would still give me considerable returns on the stock. If I take it on an annualized basis, that is still giving me very good returns per
Yes.
year. Um,
220 to 360 is almost like $140 per stock, and
right,
360 is around 33 delta, which means that there is 33% chance that Google will hit 360, and you're getting a considerable premium as well on this. It
right,
is
right.
5 to 1850 is the bid ask. So if it gets filled in the mid price,
Okay.
it's around
And
1,800.
it's also 360 from Google's price now is also quite a bit higher, right? Like it's almost $100 higher than where it is now. So that also gives a safe margin.
So true, so true. Absolutely, absolutely. So, and also it will have at least a minimum of 3 to 4 earnings season. So
In
whenever
between.
there's a dip, then I mean you can just write this covered call, and it doesn't require a lot of day-to-day management, if I may say. Right? You can just write this covered call at the 360 because you are absolutely fine with your stocks getting called away at 360.
All the way, and I don't mind holding it either, right? I don't
You don't
really, yeah,
absolutely. So if you see 360, and this also, let's say that if around earnings, this also you don't have to hold it till December 2026.
right.
Especially having it right before earnings gives you a real good advantage, because if Google falls tomorrow after earnings, you can just close this for gains and then re-enter this as well.
Okay,
Right? You can just close this book. Let's say Google drops to 250. As per this graph, tomorrow if it falls down to 250, you will probably make. Uh, I'll have to change this. So let's say Google falls down to 250 tomorrow after earnings, or let me say 200 10:30. So on 10:30, this would have, this covered call would have gained $506. You can
right.
close this covered call and re-enter when Google stock goes up, or you can just write this as well. It's not mandatory that you have to manage
No.
it immediately after earnings. This is just a way
Mm,
to protect your stocks, because currently it is having this much of gain, and then if it falls down to 250, then this covered call is kind of giving you additional comfort and hedge towards
insurance.
stocks that you're owning, the 100 stocks that you're owning. So this is another way of doing it. And if, as you can see here, so you're capping your max potential at 15,820. And since
Right.
you're 1 year far out from now, let's say if it gets called out by December 2026, it will be only long term gains for the stocks.
Correct.
This was something that you kind of are okay with, right? Because you've made money from the stocks that you
Right.
went to
Yeah.
20, and it has gone up and it is getting called away. And if you don't want this to get called away, you still want to hold on to your stocks, you always have ways to roll this covered call further as
Okay. All right. I think that sounds great. I think I'm going to very likely maybe enter the long dated covered call because it seems to me that it has the same advantage as the short dated covered call in terms of the protection for the underside, and I can still exit it in case the stock falls. Um, so maybe that gives me a little bit more flexibility. Um, that's my current take on it.
well.
But okay.
But
So if you
one
go,
caveat on the long dated covered call, Ramya, is if it keeps, see, trading is also emotional, right? If it keeps going up,
right,
and this will continuously lose value. Whereas this 300, if Google doesn't hit 300 by December 19, 2025,
you
this
get
will
to keep
expire
the
worthless, which means that you get to retain this entire $560.
entire.
And then you can write another. See, if you have the patience and time to do this every month or around every earnings, at least every quarter, You can go for, because a lot of people for short dated ones, because this expires soon, right? So you
Correct.
have to manage it, or you have to go through those emotional ups and downs when it
True.
goes up. See, when you have entered a covered call and if it falls down, it's always good because your covered call is gaining value and you feel like you've protected your stocks quite good. Let's say if Google after earnings jumps to 310,
Right.
the human mentality is, oh, my stocks would have gained much high. See, if,
Right.
let's say Google goes to 310 after earnings. I mean, I'm just taking an hypothetical example, not necessarily true. See, the stock would have gained
Right.
$9,000, whereas along with the covered calls, it is only 7,302. So mentally, we should be prepared to see
Prepared.
these ups and downs. Like if it goes to 310, if this covered call has lost value of minus 1,007, close to minus $1,700, we should not think that, oh, I entered this and then this is kind of gone up, this is a big mistake and all that. So we should be prepared for that. Either
Correct.
you can roll it further, because you can roll it further out to 400 by booking this loss, or you should be, how do I say, you should be content with
The
your
gain.
stocks
Yeah.
getting called away at 360 plus. Ideally, I mean, you're basically, if it gets called away, you're actually selling your stocks at 360 plus this cost basis,
Right.
because you've received this premium. So you're technically giving away your stocks at $378, and it will not get called away immediately as well, because you've gone far out 1 year. The action is not immediate, and you will have to go through the ups and downs of the stock price movement, and you should be prepared for that. That's the only, I wouldn't say downside, that is the only thing that I would say that you should be cautious
Yeah.
about.
Yeah. 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 So let me uh, have a internal debate on which way I should go.
I know. I mean, to be honest, if I mean, I would have gone for a long dated covered call, because I feel that, getting that premium and also with multiple earnings going up and down. Personally, that is a personal choice. But
Right.
typically, people go for short dated ones when it comes to selling premiums, be it a sell call or sell
Correct.
put. Personally, I would have gone for this, because I would have also thought like the same way that you said. If it gets called away, it's short term gains. This one, I have time to adjust it as well. I want to kind of, have that control with me, and I would have personally chosen this one over this. But that's definitely, like I said, is a personal choice.
Okay. At least I have a couple of options that, I can try and enter.